Have you ever wondered how investing works? Do terms like stocks, bonds, and portfolios seem confusing and intimidating? If so, you're not alone. Investing can seem daunting for beginners, but it doesn't have to be. In this video, we'll walk through the basics of investing step by step. I'll explain key concepts in simple terms, so you can feel confident getting started. By the end, you'll have a solid foundation for making informed investment decisions and building long-term wealth. Let's dive in. Why is investing so important? Investing gives your money the potential to grow faster over time. This is critical for building long-term wealth and securing your financial future. Investing puts your money to work for you. Over time, compound growth allows your money to grow exponentially. Even modest, consistent returns can add up. That's why investing is so important. It gives your money the potential to grow much faster than just saving in the bank. Different asset classes for investing. There are many types of investments, also called asset classes. Each has unique characteristics, risks, and potential returns. Major asset classes include stocks. Stocks are also called equities. When you purchase stock in a company, you become a fractional owner. Stocks provide an ownership stake in a company, along with the potential to share in profits and growth. Bonds. Bonds are essentially loans issued by governments or corporations. When you buy a bond, you loan money for a defined period and earn interest on the loan. Bonds are considered lower risk than stocks. Real estate. Buying property like houses, apartments, land, and commercial buildings. Real estate can generate profits through appreciation when sold, along with rental income. Commodities. Physical natural resources like precious metals, oil, agricultural products, etc. Commodity prices fluctuate based on supply and demand. Returns are quite volatile and unpredictable. Cryptocurrency. Digital currency and blockchain assets like Bitcoin. Crypto has seen tremendous price volatility in its short history, delivering extremely high gains for some investors along with huge crashes. Cash equivalents. Very safe but low return assets that provide liquidity, like money market accounts, CDs, short-term bonds, and treasury bills. These help reduce portfolio risk but offer minimal growth of 1 to 3% annually. Which of these asset classes is right for you depends on your specific goals, timeline, and risk tolerance. Most portfolios include a strategic mix across several asset classes to balance risks and returns. We'll dig into this more soon. First, let's better understand how the stock market works. How the stock market works? The stock market connects investors to shares of publicly traded companies. It's where stocks are issued, purchased, and sold continuously throughout each trading day. Major stock exchanges like the NYSE and NASDAQ act as centralized marketplaces. This provides an efficient way for buyers and sellers to conduct transactions. Some key points on how the stock market functions. Share prices fluctuate constantly during market hours based on supply and demand. More buyers than sellers drive prices up. More sellers means prices drop. Investment banks help companies issue new shares of stock in initial public offerings, IPOs. This is how privately held companies become publicly traded on exchanges. Brokerage firms facilitate buying and selling of stocks for investors, either online, over the phone, or via financial advisors. Indexes like the S&P 500 track the overall stock market performance of their underlying group of stocks. Although day-to-day movements are unpredictable, stock prices tend to increase over long periods as company earnings grow. There are inherent risks in stocks, but losses only materialize if you sell. Time in the market is more important than timing the market. Now you know how the basic stock market machinery works. Next, let's look at the risk vs reward relationship for different investments. Understanding risk vs reward. When looking at various investments, there is always a relationship between risk and return. Typically, assets with potentially higher long-term returns come with higher short-term volatility and risk of loss. Stocks have generated the highest average annual returns over time, but also experienced bigger short-term price swings. Real estate returns are high on average too, but involve leverage and illiquidity. Bonds offer more predictable returns with less volatility but less growth. Let's illustrate this on a simple risk vs reward spectrum. On the low end are stable, lower return assets like cash equivalents and short-term government bonds. In the middle are moderate return and moderate risk assets like bonds and dividend-paying stocks. And on the higher end are more volatile, higher return assets like growth stocks, speculative sectors, and alternative assets. Choosing investments wisely. Being a successful investor doesn't require luck or timing the market. It's about consistently making wise investment choices. Here are some guidelines for choosing investments wisely. Focus on the long term, not short-term price fluctuations. Tune out the noise and stick to your plan. Consider total return from income and appreciation, not just share prices. Evaluate fundamentals like financial strength, competitive advantages, leadership, and growth trends. Opt for low-fee investments whenever possible to maximize returns. Reinvest dividends, interest, and gains to benefit from compound growth. Hold quality investments for 5 to 10+ years to realize their full potential. Maintain proper allocation aligned with your goals and risk appetite. Rebalance periodically. Abiding by these sensible principles will help you construct an investment portfolio positioned for long-term success. Building a balanced investment portfolio. Combining different asset classes and securities into a cohesive portfolio is key for managing overall risk and optimizing returns. This process of strategic asset allocation aligns your investments with financial goals. Ideally, you want a diversified mix that offers exposure to growth, income, and stability. Here are some guidelines for constructing a balanced portfolio. Growth assets like stocks make up 50 to 70% of the portfolio. Focus on stocks with solid fundamentals. Income assets like bonds and dividend stocks comprise 20 to 40% of the mix. They generate cash flow and stability. Alternative assets like real estate and commodities can occupy 0 to 20%. Their lower correlation to stocks and bonds helps diversify risk. Maintain 2 to 6 months of living expenses in cash savings accounts for emergencies and liquidity needs. Revisit your target asset allocation at least annually. Rebalance back to targets if drift occurs. Adjust allocation over time to reduce risk as retirement approaches. A diversified, balanced portfolio provides greater stability and lower volatility compared to investing exclusively in single assets. Combining growth, income, and alternative investments builds a resilient portfolio for various economic environments. Managing taxes, fees, and costs. Taxes, fees, and other costs all eat into investment returns. That's why it's crucial to minimize these expenses wherever possible. Here are some tips. Use retirement accounts like 401ks and IR as to defer or avoid taxes on gains. Hold investments for over 1 year for preferential long-term capital gains tax rates when you do sell. Index funds and ETFs have lower fees than actively managed mutual funds in most asset classes. While taxes and fees can't be avoided completely, choosing tax-efficient strategies and low-cost investments prevents unnecessary expenses from eating away at your returns. Paying attention to these details matters over decades of long-term compound growth. Getting started with investment accounts. Now that you understand the investing basics, it's time to open some investment accounts and put your money to work. Here are some of the best options. 401k. Access to excellent tax benefits. Many employers provide matching contributions up to a percentage of your salary. IRA. Individual retirement accounts. Traditionally funded with pre-tax or tax-deductible contributions. Roth IR as use after-tax money, but offer tax-free growth. Individual brokerage account. Open an account with an online brokerage firm like Fidelity, Vanguard, or Charles Schwab. Allows investing in stocks, ETFs, funds, and more. Robo-advisor accounts. Low-cost digital investment platforms that use algorithms to automatically invest and manage portfolios. Being proactive about saving and investing is one of the best things you can do to secure your financial future. Consistently setting aside money to put into these accounts will allow you to take full advantage of compound growth and build significant wealth over time. The key is getting started now, putting in the work to learn, and sticking with it for the long run. Patience, discipline, and consistency equals success. We hope this video provided a great overview of investing basics you can put into action. Investing seems complicated at first, but just boils down to common sense principles. Focus on the fundamentals, keep learning, stay diversified, minimize costs, and let compounding work its magic. Also, please subscribe for more videos on building wealth and other finance topics. Give this video a thumbs up if you found it helpful. Thank you so much for watching.